In part 2 about trusts, we're going to talk about taxes. As Sedelia says, the sexy part. So when we talked about tax or trust last time, we talked about how they're like people, or that's how they're treated. And when I think about people, people pay taxes. So how does taxes work for a trust?
You got it. Even though a trust is not a separate legal entity, a trust is a separate taxable entity. Trusts are taxed as individuals, separate from the settlor, separate from the trustee, and separate from the beneficiary or beneficiaries. Trusts are required to file what's called a T3 form, which is a trust income tax and information return.
Okay, so very similar. T3 instead of T4.
That's
And so what are the tax rates like for trusts? Are they different than what they are for people?
They are. That's a very good question. They are different because a trust, right away, a discretionary family trust would pay a flat tax rate at the highest, the top marginal tax rate on every dollar of income, versus an individual that has access to graduated, stepped up tax rates. And just to give you an example, for the 2020 tax year, the top combined federal and provincial tax rates range between 44.5% and 54% for ordinary income. They range between 22.25% and 27% for capital gains. And they range between 28.33 and 42.61% for eligible dividends, and 36.82% and 48.89% for non-eligible dividends. You can see that trusts can be exposed to very high tax rates.
And variable, hugely variable.
Variable, because it depends on the province in which the trust is resident.
Right. Who pays these taxes? Where does it come from?
Yeah, so even though the trust doesn't have access to graduated tax rates, they're often used in tax planning. And that's because a trust can shift its income, it shifts its taxation of income to the beneficiaries by making an amount payable in the year, i.e. make a distribution to the beneficiary. And then the beneficiary would include the amount in his or her income for the year.
And when it comes to trust, is it treated like people where there's a certain date for when the taxes need to be collected, or is it like a company where you kind of choose your year end and when the taxes are paid?
Yeah, so a trust is like a person, like a human being, in that there's always a calendar year end. So the year ends on December 31st. Unlike a corporation that can choose June 30th or November 30th as a year end.
Okay. And along a similar question, so there's different types of income for a person, different types of income for a corporation that are considered. What is considered taxable for a trust? What type of income?
So the general rule is that when a beneficiary receives income from a trust, it's characterized as property income from an interest in a trust. But certain types of income, like dividends and capital gains, can retain their original character. So because they retain their original character, they have different tax treatments on these specific types of income. For example, capital dividends can retain their character only for specific purposes that generally relate to disposing of an interest in a trust and certain stop loss rules. Gains from a qualified small business corporation, what's called a QSBC, these shares can retain their character and a beneficiary can utilize the capital gains exemption. This is amazing because it allows a family whose members are beneficiaries of a trust to multiply the lifetime capital gains exemption that's allowed when they sell their shares in a qualified small business corporation. This is really nice tax planning. And then losses. The provisions that deal with flow through of income to beneficiaries don't include losses. So you have to be careful about that.
Okay, well, I'm so glad I have you to talk to around trusts because it gets quite complicated, I can tell, with how they're treated. And thanks for explaining to us today taxes with trusts.
My pleasure.